I'm here with Didier Saint-Georges, member of the investment committee at Carmignac. Mr. Saint-Georges, due to yield considerations, are there any other interesting asset classes besides stocks right now?
Yes, hello. Right now, the equity markets, in our opinion, are quite vulnerable because they fail to reflect the fact that economic growth might still disappoint, deflationary pressure might be higher than expected, and central banks might be less and less effective. Therefore, keeping some long-duration assets, such as US Treasury bonds, would probably be still interesting to balance a portfolio.
And are there specific regions you recommend investing in, like for private investors?
Certainly right now, the markets are being extremely positive on Europe, considering that the recovery is starting to take place, while at the same time they're very worried about emerging markets. Therefore, there is room probably in a lot of portfolios to add to some emerging market names, the ones that have been battered massively. Not so much because the emerging market region is doing better, but because certainly in terms of valuation, one can start finding some interesting investments in this region.
You already mentioned the Eurozone, but the European Central Bank might increase their monthly asset purchase program soon, probably in December. Would this mean that the European stocks are even more attractive then?
That's the big issue. The main driver behind European equity markets has been all the work done by Mario Draghi to inject liquidity. And the markets have been happy with that, and they might still be happy whenever he adds even more liquidity. The problem is that it's getting very little traction on the real economy. So in our opinion, it is getting less and less justified to support or to have a very positive view on markets that are driven simply by liquidity when the real economy is not following. That's very much the case of Europe. Therefore, in the short term, the liquidity trick might still work, but in the medium term, in our opinion, it becomes less and less convincing.
You said less and less convincing, but also it looks like the economy in the Eurozone is a bit on a recovery path. So is this additional program even necessary at all?
Well, the recovery path is undisputable. The problem is the magnitude. If everything goes well for the rest of the year, economic growth in Europe will be about 1.5%. That's still extremely low, and that makes the Eurozone very vulnerable to any external shock. Now, external shocks may come, probably will come, and you can have the rise in interest rates in the US. You can have a slowdown in the US, which is not expected by many analysts so far. You can have a further shock in the growth coming from emerging markets. So yes, Europe is recovering, but it's still extremely fragile.
Another big topic in financial markets, of course, is the interest rate of the Federal Reserve. What do you think? Is the market getting a bit impatient with the procrastinating Fed?
Well, I think the markets have to realize that their job is very difficult, but the job of Janet Yellen is even more difficult. She's really stuck between a rock and a hard place. On the one hand, she does want to raise rates in order to get some kind of room for maneuver, in order to be able to cut rates when the slowdown comes. But at the same time, she can feel that the slowdown is already coming. So to raise rates now could be in the face of a slowdown, which of course would then be a policy mistake. So the markets are getting a bit schizophrenic, and they would love to get the signal of confidence coming from the Fed via a rate rise, but at the same time they realize that it could be a policy mistake. So I think the markets, depending on what will be the exact psychology prevailing when Janet Yellen makes her decision, they might react differently. In our case, we tend to consider that whatever she does, the reality is that the markets will be disappointed by the US economic performance, and therefore, even if there is a positive reaction, it won't last very long.
Is it even possible that it's going to be a crash when the first interest rate hike of the Federal Reserve comes?
Well, you can never tell, how the markets react, and sometimes they do overreact. It can be a strong market correction, or it can be the beginning of a bear market. Who knows? The situation is simply that there are two developments that are on a collision course. One is the economy, and I think the markets underestimate the fact that the economic cycle is about to turn. The US is about to slow down, China keeps slowing down, and at the same time, it's becoming less and less supported by monetary policy in the US. This collision is quite dangerous for markets. So I suspect that right now the markets are just cruising on the fact that they got used to support from central banks, and that situation is becoming more and more shaky.
We already mentioned the Federal Reserve and the European Central Bank as they are or were pumping liquidity into the markets. Isn't this going to be a problem to get rid of this high excess liquidity in the next years?
Yes, it's going to be a huge problem. When QE started in the first place, everyone could understand that it was necessary to avoid a major economic collapse. Since then, in the US, you had QE2 and QE3. Maybe at one point we'll have QE4. And it's not about dealing with an acute crisis. It's about not being able to get out of monetary and very easy monetary policy. And unfortunately for the markets, it's going to be more and more clear that the economy doesn't allow the central banks to withdraw their support because the economy is just not getting strong enough. So it's a bit of a situation which is going to become very uncomfortable for markets. They pushed back that period for several years, thinking, well, exiting from QE might be an issue one day, but it's further out. Well, the time is coming now, and it's quite clear that in the US, precisely, it is becoming very difficult to get out of QE and to raise rates. In Europe, Mr. Draghi is going to have very little choice but to add support. In Japan, probably it's going to be the same thing. I'm afraid the market's going to realize that it was a lot easier to get into QE than to get out of it, and they might start getting nervous about it.
What about deflation? Is it also going to be an issue in the next time?
Yeah, it's definitely an issue. If you look at the industrial capacity worldwide, it is clearly in excess. But it's very clear in China, where the slowdown has very much affected the industrial part. So you have a lot of excess capacity, and that is pushing down clearly prices. It's true of the whole emerging market area that is trying to compensate for the lack of volumes by pushing down prices. And generally speaking, even in the US, for the past 6 months or so, capacity utilization has been coming down. So the deflationary pressures are still very strong indeed.
You earlier mentioned QE4. You think this is going to come?
Well, it's a possibility. I think the markets are very concerned about a rise in interest rates. They may underestimate the fact that in reality, it will be very difficult to go past maybe a first rate hike and a first attempt by Janet Yellen to do something until she realizes maybe a few months later that it's very difficult to start raising rates when the rest of the world is easing. Because if you do that, your currency starts appreciating and it slows down very much your economy. That is today a risk for the US. In that were to happen, instead of raising rates, she might have to actually add more liquidity in the future. Surely that would be taken as a major failure of monetary policy, and that would be bad news for the markets.